In this video, we're going to have a look at Shell, one of the biggest oil and energy corporations in the world. And people love them, people hate them, but the truth is they play a very big part in our everyday life. Now, it wasn't too long ago that Shell was both a Dutch as well as a British company, but recently they moved their entire organizational structure to the United Kingdom to make the most of their tax benefits. So Shell has been around for quite a while. So let's see how they have been performing for the past 10 years. So let's see if Shell is a good buy right now, and if we do buy it right now and hold it for a decade, do we think we can outperform the market? Diving right into their financials, I think the first thing that you'll probably notice when looking at these numbers compared to previous companies is that their numbers are ridiculously high. Now, whenever I make my own financial sheet, I always use millions of euros or dollars or krona or whatever the currency is. I always tend to use millions, and that is what I did with this financial sheet as well. So don't be alarmed by the big numbers. I really did use billions for this one. It's just that Shell has an insane revenue number as well as earnings number. Now, as is displayed on the left of my column here, the entire financial sheet of Shell is in dollars, because Shell also uses dollars when they report their 10K, when they report their annual report. Because of course Shell was both a British as well as a Dutch company previously, which used both British pounds as well as euros respectively. So I think to maybe choose a middle ground there, maybe they chose for dollars. I'm not exactly sure, to not try to anger either country. I'm really not sure what the reason is, but the truth is they use dollars whenever they report their numbers. So I also use dollars for this financial sheet, and I also use dollars when looking at their price per share. So what I did then is I took their share price, which is in euros as they are listed on the Euronext exchange, and transformed that to dollars so we can actually work with the rest of the model. So diving right into their numbers, what we can see here is that their revenue numbers are ridiculously high, and they started off at around $470 billion in revenue in 2012. Now, for the past 10 years, this number seems to have dropped to $261 billion here in 2021. So this is actually quite a steady decrease in revenue numbers. Now, in all fairness, in 2022 they had a record year when it comes to their earnings, and they posted a revenue of 380 billion. So this number is going to come up, and we'll take that into consideration as well. But I think the overall trend that we see here when it comes to their revenue is a steady decrease. So when we move over to EBITDA, what we do notice here is that it doesn't really decrease nearly as much as their revenue has. Their earnings are remaining relatively stable over time. 59 billion here in 2012, 55 billion here in 2021. Of course, they do have some lower numbers occasionally as well, because of course it is an energy company and they are very dependent on the price of oil and the price of energy in the market. So of course their earnings will fluctuate based on that. But I think overall we see a relatively steady decrease here in their earnings as well. Although I think it should be noted that their earnings aren't decreasing nearly as fast as their revenue is. So this very much means to me that they are able to increase their margins. It means that they are more effective in operating their business, and they're able to increase the margins of profit, which is very nice to see. So looking at debt level, we can see here in 2012 they had a debt level of 19 billion, quote unquote only 19 billion. Now this number has been steadily increasing for the past 10 years by about 15% every single year, and they had a peak debt level here in 2020 of 108 billion. Now the thing is that earnings isn't really growing that much, so I actually am a bit scared when I see that debt level rising as much as it is, but we'll see whether or not we think it's risky or not later down the line. Excess cash on hand, it seems they always have some additional cash on hand, so of course when push comes to shove they can use this cash to pay down the debt, or they can use this cash to do additional acquisitions, or basically whenever they want with that cash. It's a bit of a cushion for us as an investor as well, so I very much like to see that. And this then brings me to market cap, and I think overall what we see here is a very, very steady trend. The market cap, so this is the price as seen on the stock market itself, has not really been increasing or decreasing all that much. And I think this is mostly because their earnings really hasn't been increasing or decreasing all that much. And if you do not expect the earnings to grow in the future, why would you pay additional for a company? It makes no sense. So I think it makes actually a lot of sense for the market cap to remain very stable because the earnings doesn't really seem to move. Enterprise value is the entire value of the business. So it's the market cap, which is the shares on the stock price, to which we then add the debt and we subtract the cash. And what we see here that the enterprise value is actually increased a little bit over time, contrary to their market cap. And this is mostly because, of course, their debt level has been increasing relative to their cash level. So their debt level has been increasing relative to their market cap. So this is why we see a bit of an increase here in enterprise value, which is only fueled by their increase in debt level. EV/EBITDA ratio, we see a very, very low multiple here, I think, for a company that is this big, of 5.1 times average for the past 10 years. Now, I think we see this number for the exact same reason that the market cap hasn't moved in the past 10 years, which is to say that their earnings is not moving. So there is no reason for the market to pay a premium for a company that is no longer growing. So I think a 5 times multiple is quite a fair valuation for a company like Shell, which is no longer growing. In fact, I think it's actually decreasing in top line revenue as well as bottom line earnings. So I think 5.1 is quite a fair number there. Looking at their net debt to EBITDA ratio, let's see how well are they able to finance that debt if they are required to. Overall, we see that their net debt to EBITDA ratio has been around the 1.6 times, which is still very much in the safe region, I do want to say. Now, as we can see here in 2020, they had a relatively high debt level and very low earnings comparatively. So this was a bit of a risky year, as was 2016. And I think they started to realize this as well, because in 2021 they started to buy back some of their debt to decrease their leverage. And I think with their record earnings in 2022 they did a very similar thing, which is to say they also used some of that money, a lot of that money to reward investors in all fairness, but they also used a little bit to pay down their debt level because it was getting a little bit scary towards the 3 times ratio, as we can see over here. But overall, I don't think Shell is in any way in risk of bankruptcy, and I think this debt level makes it a relatively safe investment as of this moment. So this then brings us to their cash flow from operation, and what we see here is a very similar thing as with EBITDA, which is to say that cash flow from operation hasn't really been growing, but it also hasn't really been decreasing that much. It's been remaining relatively stable. And this brings us to capital expenditure. Now, sometimes people will probably ask me, why do I want to use EBITDA when it comes to that earnings level? Because it does not involve depreciation, amortization, or taxes. And I think that is a very fair argument. The reason that I do this is because I want to see, when all the investments are said and done, whether or not they're able to increase their bottom line, whether or not their raw numbers are increasing apart from any expenses that they have to make. So the moment that I look at cash flow and I look at capital expenditure, I think this very much compensates for the fact that I do not include amortization and depreciation in my earnings number, because capital expenditure is the funds used by a company to acquire, upgrade, or maintain physical assets such as property, buildings, equipment, or technology. So the moment that a fleet of fuel trucks is going to be decommissioned because they reach the end of their lifespan, of course it's going to have to be repurchased, and we see the direct purchase represented in their capital expenditure. Whereas the moment that an asset like a fuel truck is depreciated over time, it is being depreciated over about 10 years, and maybe even after those 10 years the truck can still run properly. So it doesn't really give an accurate representation, in my opinion, of the actual expenses of the business. And I think capital expenditure gives me a very direct and raw number when it comes to the investment that they have to make to keep maintaining their business. So that's why I want to use EBITDA for earnings and capital expenditure to get an insight into their depreciation and amortization, or like the cost of running their business. I might make a video later to explain it a little bit more in depth, but just in a nutshell, that's the reasoning that I try to use whenever I make these spreadsheets. So going back then to capital expenditure, because I think this is very much the pretty part about their financials, which is to say that their capital expenditure, the investment that they have to do to keep maintaining their business, to keep on operating the way that they are, the cost of that is coming down. It's coming down by about 5% every single year. So the reason that their free cash flow is increasing is because they're able to reduce the cost of operating their business. They're becoming very efficient, and mostly their margins are increasing because of the difference between cash flow and capital expenditure, which is very nice to see. So this brings us to free cash flow. We see an overall increase of about 7% every single year, comparing the 13.5 to the 26 billion here in 2021. Now, of course, we do see the occasional year of negative numbers because, of course, like I mentioned, their earnings are very dependent on the market price as well as some other macroeconomic variables. Looking at their shares outstanding, and this is a bit of a less pretty picture, I do think, because even though they have been creating quite a lot of free cash flow, they are still required to dilute their share count to keep on funding their operations. And I would have actually liked them for the past 10 years to buy back some shares instead of dilute them and then increase the dividends. So I think for the last few years, like seen here in 2019, 2020, they have been buying back shares to reward shareholders, and they've been doing the same in 2021 in their defense, but I would have liked to see it a bit earlier as well. Although I do think if you want to invest in the company now, it seems they are on the trajectory of reducing their share count as a way to reward investors. So this brings us to free cash flow per share. Take the free cash flow divided by the amount of shares outstanding and you get this number. So we can see here that their record number in 2018 was $3.60, and the lowest number was here in 2016 of a negative 19 cents. Now I do think it's important to know that that dividend has been coming down steadily for the past 10 years. They pay out less in dividend than they have in 2012, 2013, because their business by and large has been reducing in revenue as well as earnings level. So price per share. So what I did here is I took the price in euros and multiplied it by 1.07, which is the current exchange rate between dollars and euros. So if you look at this video at a later point in time, what I would advise you is to alter the numbers a little bit, alter for the proper exchange rate at the time. On the 20th of February 2023, the exchange rate is 1.07. So we can see here again that their share price has been coming down for the past 10 years. Overall, we do see a fairly high share price right now because of the extreme record year that they had here in 2022, but we'll get to that in a little bit. This brings us to their free cash flow yields. Now, these numbers here are a little bit shaky because of the irregularity in their earnings. So of course they had a negative earning here, and they did have a relatively low earnings here in 2013 because their capital expenditure was so high. So of course these percentages do kind of influence their average yield of 7.5, and I do think this yield should be a lot higher than this because I think it's impacted a lot by these numbers. I think overall between the 10 and 15% is probably an accurate way of estimating and projecting this business into the future. So this brings us into the business of trying to forecast Shell into the future. So what we know already is that Shell has posted a revenue in 2022 of about $380 billion. So about a 50% increase from the 2021 numbers. Now I'm not exactly sure whether or not this all translates into earnings as well at the same percentage point, but I'm going to assume it roughly does. I'm going to give them a 45% increase here in 2022, which gives them an EBITDA of 80 billion. But I also know that this number won't really hold steady. I know that this number may be a bit of a painted picture because of the extremely high oil and energy prices here in 2022 as a result of the war in Ukraine. So I think this number is going to come down as it has already in the past few months. And I'm going to say it comes down by about 30%. And after that, what I'm going to do is I'm going to take the historic average of the growth for Shell, which is on average a decrease of 1%, and I'm going to keep on doing that for the next 8 years, because I'm not sure what is going to happen. I think the energy prices might fluctuate a lot, but I can't really account for that. So all I can actually do is take their historic numbers and go with it. So this means that 10 years from now, I expect an earnings before interest, taxes, depreciation, and amortization of about 51 billion. I'm going to keep the 5 times multiple as we've seen historically, because I think it's a fair multiple for a company that is decreasing in earnings and decreasing in revenue. This gives me an enterprise value 10 years from now of $257 billion, to which we subtract the debt, we add the cash, gives me a market cap of about 220 billion, divided by the amount of shares outstanding, gives me a share price 10 years from now of $28.08. And I'm going to do a similar thing here for free cash flow. So I'm going to say I take this number here of 2021 of $3.34, and I'm going to increase it at the same rate as I did their earnings. So by 45%. But after that, I'm going to say that their free cash flow is going to come down, because I actually do not believe they're able to maintain this number. And I want to be a bit more conservative with my free cash flow estimate, because as we've seen historically, is that even though they did have high numbers here of 3.6 and 2.37, 3.34, they also had some negative numbers like 0.07 as well as negative 19 or 0.58. And I think overall the average free cash flow per share, as seen from these 10 numbers, is around the $2 range. So I'm going to use this $2.42 as the average free cash flow per share for the past 10 years, and then I'm going to keep on growing that for 2% every single year. Because even though their earnings are decreasing, even though their revenues are decreasing, their free cash flow per shares are increasing because they've been able to reduce their costs as much as they have. So historically, they've increased their free cash flow per share by about 4%, but I think there's only so much cost that you can cut. So I think for the next 8 years, I'm going to increase it by 2%, which leaves me with a free cash flow per share 10 years from now of $2.84. I'm going to attach a 10% free cash flow yield to it, which I think is relatively nice to Shell, because I think it might be a bit higher in the future because of their decreasing earnings. But I want to be a bit nice to Shell as well, and I'm going to say it's 10% yield. This gives me a share price 10 years from now of $28.41. So when I look at the stock market right now, I can buy as many shares as I want for €28.52 or $30.52. If I take both my projections and cut them down the middle, I get an average share price 10 years from now of $28.24. Now this means that for the next 10 years, I expect the share price of Shell to come down by about 0.8% every single year. But of course, this is not the entire picture, because Shell is very cash flow positive. They are very much a free cash flow machine, an absolute cash cow if you will. And if we include the free cash flow that we expect to receive as we have projected in our model here to the left, then I expect Shell to return about 10% every single year. Now, I always say, on average, the stock market returns about 10% a year. Now, given that information, I expect Shell to perform roughly in line with the overall market expectations. Now, the thing is, the moment that they have some negative earnings for a few years, what you will quickly start to notice is that their IRR is going to come down quite fast. So, of course, there are still quite some variables involved into this IRR. Of course, Shell is mostly known for being an oil company above anything else, an energy company, an oil company, and I think the use cases of oil in the future might not be as prominent as they are right now. Now, it's also fair to say that Shell has been investing into renewable and green energy, so maybe they can get some additional market share from that in the future as well. But I think if they keep on relying on their oil, I think it might be a bit of a tricky and risky business into the future. So let's see what happens if the price starts to come down. Let's see at what point I think I'll be interested in buying this stock. So what we can see here is that right now for $30.52, I expect an IRR of about 10.8%, which is about in line with the market expectations. And I think if that is the expected return, I think I could get a better return elsewhere. So the moment here that the share price starts to come down, I think to about the $24, maybe even $22 range, I expect an IRR between the 18 and 15%, at which point I will be interested. But as of right now, at $30.52, I will not be interested in buying this stock because I think there is better stocks out there. So this was it for Shell. Thank you very much for watching. Don't forget to like, subscribe and all that good stuff, and I'll see you in the next one. Cheerio!